Myself, Dr. Supriya Sangule. I am working as Assistant Professor in DRK College of Commerce, Kolhapur. Today in this lecture, we are going to discuss about the contents of first unit of your SY BCom syllabus. Friends, first unit is entitled as Accounts of Limited Company Part 1. Here in this topic, we are going to discuss issue, forfeiture and reissue of shares and redemption of preference shares. So, before starting all this discussion, I think we should know what is meant by company and shares. So first we are going to try to understand what is the meaning of a company. Friends, a company is a legal entity formed by a group of individuals to engage in and operate a business, commercial or industrial enterprise. So here it is clear that company is a legal entity and it is created with the view to run a business or commercial industrial enterprise. It is often called as joint stock company. It is an artificial person created by law. So according to the law, company is treated as a person but a artificial person. So therefore company is separate from the owner. And as such, its life also comes to an end, that is liquidation by operation of law. Joint stock company is the form of organization emerged to remove the main defects or limitations of the partnership form of organization. That is, first, shortage of funds, and secondly, unlimited liability. Huge capital was required for use of costly machinery and large-scale operation of production. It was therefore felt necessary to collect the capital from the public at large and to encourage the public to contribute capital. The principle of limited liability was adopted. Thus, the capital is collected from the public in the case of public limited company. Okay? So therefore, we can say that company can collect the capital from the public and runs the business organization. It has also status by the law. Now we are going to understand the types of companies. Mainly, there are two types of companies. From the viewpoint of public investment, there are two types: vice, public limited company, and private limited company. Now, we are going to understand what is to be called as public limited company. A company is called as public limited company when it invites the public to subscribe for any number of shares or debentures. Shareholders of the company can transfer their shares. So here in the case of public limited company, the shareholders can transfer their shares. There is no limit on the maximum number of members. Now in the case of private limited company, it is which by its articles, it restricts the right to transfer of its shares if there is any. It limits the maximum number of its members to 50. In the case of public limited company, such limitations were not there. Okay? Excluding the present or past employee shareholders. It also prohibits any invitation to the public to subscribe for any shares or debentures. Friends, a private company has to raise its capital privately, which means it cannot invite public to subscribe for its shares. The minimum number of members required to form a private limited company, that is 2. There is limited liability because liability of members of the company is limited by shares and by guarantee. It is also called as companies limited by shares and companies limited by guarantee. A private company has to raise its capital privately, that we have discussed. It means it cannot invite public to subscribe for its shares. 2 minimum numbers of members is required. There is a limited liability regarding shares and regarding guarantee. Now friends, we are going to discuss about shares. What is meant by share? So first we should discuss about the capital, because share is a part of capital. Capital of a limited company is not contributed by few persons, but it is contributed by the public at large. The promoters of the company determine the size of capital, taking into consideration various factors, and this capital is divided into parts or units, each part or unit being of equal value. Such part or unit is called as share. Even share means a share in the share capital of the company. Suppose, for example, company may have capital of 1 lakh. It is divided into 10,000 units. Unit means shares of rupees 10 each. The company sells these shares to public and raise capital. Hence, capital of the company is often called as share capital. Now, we are going to understand what is meant by share. A part or unit of capital is called as shares. It is a unit of measure of the members' interest in the company. Suppose you are having 10% of the share capital, that means your interest is 10% in the company, and it is always denoted in the money value. Share means share in the share capital of a company. Now there are two types of the shares. First is equity share and another is preference shares. What is meant by equity shares? According to Companies Act, the shares which are not preference shares are equity shares. Friends, we know what is meant by preference. That means whenever there is a situation or condition like we have to pay money, then preference is to be given to whom? Then in the case of payment of dividend or after winding up of the company, if share capital is to be refunded, then preference is given to the preference shares. So therefore it is said that according to Companies Act, the shares which are not preference shares are equity shares. As earlier I have told you that preference shares means who have priority over equity shareholders on payment of dividend and repayment of their capital. Capital means the amount of shares they have invested in the company by purchasing the shares. So, the priority will be given regarding the payment of dividend to the preference shareholders, and even after closing of the company, the capital is to be refunded preferably to the preference shares. Now we are going to understand there are some types of the preference shares. First type of the preference share is cumulative and non-cumulative preference share. Another type of preference share is redeemable and irredeemable preference share. And the third type of preference share is participating and non-participating preference shares. Okay. See, in the case of preference shares, the rate of dividend is fixed. Suppose it is 6%, 9% or 10%, and it does not fluctuate according to the profits earned by the company. Hence it is called as 6% preference share, 10% preference share. That means the dividend will be paid to the preference shares at the rate 6% only per annum on their paid up capital. The dividend payable to equity shareholders fluctuates. That means it changes. It may be increased, it may be decreased. Fluctuates according to the profits earned by the company each year. Thus, the rate of dividend in respect of equity shares is not stable, but in the case of preference shares, it is fixed. Now we are going to discuss cumulative preference shares. This is the first type of preference shares. If the company does not earn profits or sufficient profits to pay their dividend, in such case the arrears, that means the delayed payment of dividends, are carried forward. That means it is carried forwarded to the next term. And accumulated, that means it will be saved if shares are cumulative preference shares. These arrears are paid in the future when company earns profit. What is meant by non-cumulative preference shares? Suppose if the shares are non-cumulative preference shares, their arrears, that means remaining dividend of the last term or the last year, cannot be carried forwarded, and as such these shareholders lose their right of receiving dividend for the year in which the company does not make profit or sufficient profit. So, though the preference shares have priority over equity shares for payment of dividend, even preference shareholders cannot be paid dividend if the company does not earn profits or sufficient profits to pay their dividend. In such case, the arrears of dividend, if carried forwarded and paid to the preference shareholders, those are cumulative. And if it is not paid, neither carry forwarded, not paid, then those are non-cumulative preference shares. Now the next type is redeemable preference shares. As a matter of fact, share capital of a limited company cannot be refunded during the lifetime of the company, but the Companies Act has made a provision to issue such type of shares, the capital of which can be refunded. Redeemable means repayment, or reduction means repayment or refund. These shares are called as redeemable preference shares. That means capital of which can be refunded. So amount of your investment can be refunded, but there are some restrictions laid down by Companies Act. Those are: the redemption, that is repayment, must be out of profits. So if you are making a refund of the capital of redeemable preference shares, then it should be out of the profits or out of proceeds of issue of fresh shares, or both. Okay, and the shares to be redeemed must be fully paid before the redemption. That means full payment should be made by the shareholders. Next is irredeemable preference shares. What is meant by irredeemable preference shares? Then those are shares which are preference shares, but its capital cannot be redeemed during the lifetime of the company. So refund is not made to such preference shares. The next type of preference share is participating preference shares. If the preference share are participating preference shares, these shareholders are entitled to participate in surplus profits remaining after payment of dividend to equity shareholders, and the surplus amount remaining after the payment of equity share capital. That means these preference shares are going to have benefit of to get the portion of the surplus profit after the payment of dividend to equity shareholders, as well as if surplus amount remains after the payment of equity share capital, then also participating preference shareholders can get some amount of out of that. Next is non-participating preference shares. Non-participating preference shares holders are entitled to receive the dividend only at the prescribed rate. That means the rate is fixed, and to get their capital refunded in case of winding up of the company, and they are not entitled to have any share in the surplus amount. So no extra benefit like participating share it is having. That means non-participating preference shares have no right over remaining capital after the payment of equity shares, neither on the dividend, neither after the capital refund. So friends, these concerns today we have learned and discussed about capital, company and share and its types. These things which earlier I have discussed in English, again I am going to discuss in Marathi. So kindly also listen the same and try to understand. If there are any queries, you may contact us on our groups.